January 26, 2026. A historic, brutal winter storm sweeps central and eastern United States with massive amounts of snow and ice, leaving tens of millions of people in frigid Arctic coldness. However, they would not have expected another historic storm brewing in the capital market, the same white as snow, the white metal silver. Silver price is skyrocketing more than 15% on the day, bringing its already all-time high to another high of $116 per ounce. This represents a gain of over 60% in the first 3 weeks of 2026 alone, compounding a nearly 150% rally in 2025. Unlike previous volatility, this rally is not mainly speculative. It is driven by a structural dislocation where inelastic industrial demand, specifically from the AI energy EV complex, has collided with a rigid, shrinking supply chain, worsened by new geopolitical trade barriers. This rally looks far more structural than people assume. It's not one cause, it's a stack of causes: demand, supply, macro, and market structure, aligning at the same time. Let me walk through the four parts of this perfect storm. Part 1: the industrial demand shock. The core driver is a fundamental repricing of silver from a precious metal to a critical technology metal. Industrial use now accounts for over 60% of global demand, and three specific sectors are creating a squeeze on physical inventory. First, the AI infrastructure. Boom. The rapid build out of AI data centers requires high performance electronics and connectors. Silver's superior conductivity makes it non substitutable in many high end components. This demand vector has surprised the market, acting as a new, massive sink for supply that wasn't fully modeled in previous years. Second, solar energy, PV. Despite thrifting efforts to reduce silver usage, the sheer volume of global solar installations, projected to consume over 120 million ounces in 2026, has overwhelmed efficiency gains. Third, electric vehicles, EVs. The average EV requires significantly more silver than an ICE vehicle for sensors, control units, and battery management systems. With global EV production targets remaining aggressive, this sector continues to tighten the physical market. Part 2: supply side shock, the China factor and liquidity trap. The supply side has failed to respond to these price signals due to long lead times in mining and new trade frictions. China's export licensing, Jan 1, 2026. A critical catalyst was China's implementation of new export licensing rules on January 1st. This effectively restricted global silver flows from one of the world's largest refiners, creating an immediate liquidity trap for industrial buyers in the West who were forced to pay steep premiums to secure metal. On the other hand, silver supply is inelastic. Roughly 70–80% of global silver supply comes as a byproduct of lead, zinc, and copper mining. Miners cannot simply ramp up silver production without crashing the markets for these base metals. This supply inelasticity means the only release valve for high demand is price. At the same time, the silver inventory is depleting. London Vault stocks and COMEX inventories have been drawing down for years. Some estimates show an 8-year deficit streak, removing the buffer that previously capped price spikes. Part 3: macro and geopolitical accelerants. While supply demand provided the fuel, macro factors provided the spark. Escalating geopolitical tensions, specifically reports involving U.S. foreign policy shifts like tensions regarding Greenland and Iran, and trade tariff threats, have revived the fear trade. Continued concerns over U.S. fiscal sustainability and debt levels have weakened the U.S. dollar and pushed real yields lower, reducing the opportunity cost of holding non yielding assets. Also, the gold to silver ratio has compressed aggressively from roughly 100 to the 4650x range. Traders often view this as a mean reversion trade. When gold hits new highs, silver often acts as a high beta catch-up play, outperforming gold on a percentage basis during the acceleration phase. Technical dynamics. Market structure analysis suggests a shift in buyer behavior from speculation to accumulation. We are seeing sustained inflows into physical silver ETFs, but crucially, there is evidence of structural accumulation rather than just retail speculation. The breakdown of the supply chain has forced massive short covering from industrial hedgers who were caught offside by the China export restrictions, amplifying the upward move. Summary outlook. The current price action suggests silver is undergoing a structural repricing. The market is transitioning from a surplus balance state to a chronic deficit state where industrial users must compete with monetary investors for available ounces. Here are some key risks to watch. At over $100, the incentive for solar and electronics manufacturers to engineer silver out of their products becomes extreme. Also, silver remains notoriously volatile. A resolution in geopolitical tensions could trigger sharp profit taking.